The broadcast is now starting. All attendees are in listen-only mode.
Yes, it would. Start. Hi friends, very good evening. This is Amit Singhania from the product team. Thank you so much for coming online for this seminar on ASK AIF. I have Abhishek Mehrotra, our head of investments, with us. We also have Rahul Shejwal, who's the regional head Mumbai for ASK, who will be briefing us and guiding us as to how the AIF is, how the structure is. Beforehand, I'll ask Abhishek to expand upon the new contest what we have launched for AIF. Over to you, Abhishek, please.
Okay. Hi, good afternoon, everyone. And this is the first time when we are launching a drive and where we already have a qualifier. So you all know, you may all have got a message that there is a champion from Bhopal who has already qualified for in the RM category for the drive, and he has done one ASKF. So congratulations, team. This is really fabulous, especially the branch manager Kunal and definitely the RM who will be making a big incentive out of it. So RM has anyways qualified for a trip to Bombay and definitely a good amount of incentive. And BM has to do one more. So guys, just I'll quickly take you through. It's very simple. This is this drive is for 3 months, starting from from 5th till the end of the quarter. All the business needs to get logged in, reported, and the funds need to be cleared. Everything has to be cleared before that. Please don't keep it anything for the last day, because unlike other products like mutual fund and probably insurance, there's no time for issuance or something like that. The money should come in before the cutoff, so that in the manufacturer MIS, it is clearly as a funded account. That's one thing. All RMs, it's open. The document is very simple. It's branch RM or digital center RM or if ASMs. It is open for all. AIF as a category doesn't require currently any certification, but for if you're qualifying through PMSs, you have to clear 21A of NISM. Anyways, you should clear 21A of NISM. So that's for an RM. Branch manager, depending on the people you manage, that's your criteria. Branch manager, TL of a DC unit or TL of a branch. For you, the drive is, the construct is very simple. If you have two people who have done two RMs who have qualified, you are qualified. Or if you have a single case of 2 CR, you are qualified. Similarly, for a BM or a TL who's managing 6 to 10 RMs, it is 3 cases. For a BM who is managing 10 to 15 RMs, it's 4 cases, and BM managing a larger spectrum, it's 5 cases. For clusterate who are managing 23 RMs or less, it's 5 cases, and above that, it is 7 cases. And lastly, for state heads, it is 8 or 10, depending on if it is below 70, it is 8, above 70, it is 10 as for the qualifying criteria. When I say 10, that means 10 crores of total business, which can be clubbed together, as in if you get 2 AIFs of 2 crores, we'll count it 4. And but don't club PMS and AIF. 4 PMSs will be called as equal to 1 AIF. So that's how the construct is. But our currently focus will remain on AIF more. Second thing is, you all may have heard that from next month onward, the upfront payout is getting changed in the AIF category, but that will not have any impact on your current drive. The current drive will continue for the entire quarter. What will change is probably next month onwards, we will have a different incentive structure. So if an RM does AIF in this month, he is getting 6% upfront as a revenue, and of that he can take up to 10% as the incentive, capping 2x, you are all aware of. From next month onwards, probably we are yet to get the final commercials from manufacturers, and as we get it, we will communicate how the structure will be, but it will not be 6%, definitely not be 6% or 5%. Okay, so that's how the constructed. What an achiever will get, it's a felicitation by the MD in Bombay, along with the training plus engagement program, where you all know we'll have good amount of activities together. You can explore Bombay. There are a lot of things which most of the people from outside have not yet explored. So that's in for you. So guys, it's a fairly simple drive. Please focus on it. Please identify your top customers. Each RM, I believe, has 8 to 10 customers who is definitely the target audience. Especially on the unmanaged space, there are a lot of customers who have good amount of wealth. There won't be any bank conflict. If you are doing a managed client interaction, then you need to manage it at your end, because at times it may become contradictory if it's a PVG client or something like that. Rest, you all are aware about how the MIP will be. Next month MIP will be different from this, but the credit will definitely be not as low as a PMS. We will do something better of it. But for next 20 days, if you guys have an opportunity, please try to close your business as soon as possible. In fact, there will be a lot of push across across the industry for AIFs, the same way what we have seen last month when insurance some regulatory change was happening. So capitalize on that. ASK team is there across branches to support you. If you are not getting any required support, you can raise it up to me or Amit, but I don't think so that will be the case. Now the call is specifically for ASK, so I'll request Rahul to take over now, brief them about what the fund is, give few pointers which they can tell to a client to excite him, so that he gives an appointment where our RM, BM, and the ASK colleague can together go and then conclude the call, because this is what RMs you need to understand is this is more of a warm up. What you will do over the call, the closure will happen in a personal meeting. No client give over a call once a year. You will have to go out and meet him. So this is understand what you need to talk on the phone and understand the further discussions once across the table what will happen. Over to you, Rahul, and thanks for joining in. Thank you, everybody.
Thank you. Thanks a lot. The contest sounds exciting for me as well. And kudos to Gopal team for getting off the mark. I'm sure this is start of just a big roller coaster that will be heading our way in the AIF itself. So before rather wasting any time, let me just get on to this. So yes, we have this ASK Golden Decade Fund Series 2 Cat 3 AIF, which is only listed only space and long only kind of a portfolio. Okay. Very shortly, although I know most of you would know about ASK, but I would like to still brief you a bit about ASK, so that in case there are clients who want to know about ASK a bit, you are aware about this part. So we have been into existence since about more than 40 odd years. Currently, we have an AUM of about 34,000 crores, which is probably one of the largest AUM that a PMS individually and an AIF house owns. Along with that, we have one of the most experienced team when it comes to the fund manager part of it. Bharat Shah, who is currently our executive director, has been associated with ASK for last 20 odd years or more. And prior to joining here, he was actually one of the founder members for Birla Asset Management. And by the time he left, he was the CIO for Birla Asset Management. So a wealth of experience when it comes from Bharat Shah's table. Along with him, there is Sumit Jain, again the Deputy CIO, Home Run Fund Manager. He has been managing one of our flagship products called IEP, Indian Entrepreneur Portfolio, which I think on the PMS platform is what you guys have given out to your clientele. I think by virtue of size also, that is one of the largest PMS portfolio in India. About 17,000 crores is into that portfolio itself. We talk about the strength of the overall investment team, more than 16 odd people along with Bharat Bhai and Sumit put together. I would say one of the most experienced team that you have in the portfolio management front, catering to the investment needs of clients. When you talk about long-term track record, of course, the AIF flagship product has completed about 13 odd years into the market, delivered a consistent returns of about 17% CAGR over the last 13 odd years, versus market would be in the similar time frame given about 11 odd percent as returns. Basically, it means that a crore invested into markets 13 years back would have probably grown to maybe 3.5 crores kind of a sum. Into this portfolio, it has grown at close to about 8.5 to 9 crores kind of a fund. So there is a very good outperformance and a consistent outperformance that we have seen. Of course, last 1 year has been a bit of a up and down, but we can discuss that in our question answer session again. Going forward, some of the key attributes and important pillars that any investment house has, something that we also follow, may it be PMS, may it be AIF. The core idea is to make sure that there is a capital preservation over a period of time for whatever funds that we manage, and then it is followed by capital appreciation. And these 4 pillars are very important to understand, because that is the crux of any of the products that we build around. So first is about size of opportunity, second is quality of business, third is earnings growth, and fourth is value. When I talk about size of opportunity, for us, it does not matter if it's a mid cap, large cap, or a small cap, kind of a stock. Okay? For us, basically what it matters is that how much of the industry has that, how many legs to grow further. Okay? There was a time when maybe pre-pandemic, the overall IT industry was not itself growing by more than 6 to 8% kind of thing. And you can probably take one, best of the businesses in IT space, they would have probably beaten their overall industry growth by 2 to 3%, not more than that. And that's how it normally happens. So here we are looking at, actually, is the industry itself growing at more than 10, double digit kind of a scenario, so that when we pick up businesses, at least they have the capability to beat the overall industry rate by at least 2-3%, so that we can invest into those kind of growth oriented businesses. So it is always going to be size of the pond rather than the size of the fish, because given the right conditions, today a small fish can become a huge fish tomorrow, and huge fish who's already a huge fish, given the right conditions, that can become a mammoth fish. Second part is about the quality of business. Now, quality of business at our end is measured at 2 things. One is the quality of management itself. Okay, it's very important, because management takes the decisions on behalf of the people, behalf of the company. So it is important to know how the management is there, what is their integrity, in their track record, so on and so forth. Also important to understand, the second parameter on quality front is the ROC part, return on capital employed. Friends, I'm sure you would have heard this term called return on equity most of the time in the mutual fund space. Return on equity basically means that how much of a shareholder capital is there and how much it is making on the shareholder capital, return on equity. But ROC is like a one step ahead, taking into consideration even the debt that the company might have taken, and if after servicing the debt, how much is the company making as an overall capital. So bare minimum as a percentage that we look into an ROC is minimum 15% and above. That should be the ROC as a deliverable by the businesses that we select in the last 3 to 5 years. And trust me, sir, friends, this is not an easy filter to beat. If I apply this filter to the listed stock space, which is about 6,000 odd stocks, we would not have more than probably 12 to 13% companies qualifying for an ROC of 15%. So that helps us weed out very, very bad businesses, ugly businesses. We end up having a good quality business portfolios. Third is earnings growth. We're looking at earnings as an expectation of profits from the businesses in excess of 15% as a minimum criteria for the next 3 to 5 years going ahead. And lastly is the value, basically trying to make sure that I try and buy at the best valuation possible. We use a discounted rate of 15% on an average. So any stock, for example, is trading at 100 rupees right now today. But according to our models, and if it has filtered out the other 3 parameters that I told you, and there is a gap of 15%. So if it should be trading at 115 and above, so there is a gap of 15% on, only then I will be able to get that stock in the portfolio, which is then fairly valued. So these are the broader parameters on which we have, built out our, core portfolios may it be PMS, may it be AIF. Now let's come to this part of Indian decade. I'm sure you already heard a lot of times that welcome to Indian decade. This is going to be India's best decade ever. But why is that so? And we're trying to just find some of the very important aspects. Why do we believe that this is going to be an Indian decade? Okay. What we have tried to do is that we have tried to compare, some of the global economies which are already, developed economies, when they were at this particular juncture where India is today. Maybe we are at a $2.5–3 trillion kind of an economy. From there to reach a $5 trillion economy, how much time did US take? It took about 10 years for them to reach there. For someone like Japan, they took about 8 odd years. For someone like China, they took about 5 odd years. Correct? We also believe, considering the growth rate that we have, we should also be able to reach that particular stage in the next 5 to 7 years kind of a time frame. Now, because of this, what actually happened, what it translated into was the wealth creation opportunity. Basically, the market cap size also increased. So the market cap for US doubled from where it was. Market cap for Japan actually went up by 1.3 times. For China, the number is humongous. You talk about 9 times growth. We are saying that even for India, this market cap growth will be around 2.2 to 2.5%, 5 times is where India would also be able to reach. Now, because of this market cap, what does it basically translate into? It translates into more disposable income in hands of people. Okay, and this particular graph will give you even more fairer idea. This is a BCG, the Boston Consultancy Group, has done a study on our Indian household and how this particular graph showcases where we are as a household and how things have improved from 2010 to 2019 and estimations till 2030 on how household income will improve over a period of time. So if you see on the left hand side, there is mentioned about strugglers, wherein that household is earning less than 1.5 lakhs per annum, right? And as the money goes up about 5 to 10 lakhs, which is called the aspirers, affluent is 10 to 20 lakhs, and elite is 20 lakhs plus, okay, in a year's household income. It is very clearly seen that the aspirers, affluent and elite class, which is where you will have more market participation, that particular class is growing at a rate faster than the others. Around 2.5x is what we are trying to grow at. And if that is happening, which is basically means that there will be leading to more of a value migration that is supposed to happen in each and every industry. Okay, may it be innovation by technology. The cost of capital over a period of time will obviously come down, which has been the case with a lot of developed nations. The convenience part that we've already seen. I mean, right now we are having this call done on a on an online mode, which maybe 10 years back was not really possible. But those are the changes that are there. If you look at the value migration basically occurs when there is a disconnect between customer priorities and existing business designs. So over a period of time, everyone will change as per things change, as per technologies improve. So you look at migration when you talk about inter-country migration, you talk about people moving from west, the businesses moving from west to more about IT, pharma, chemicals businesses moving in here. You talk about inter-industry migration, you talk about the manufacturing capabilities also improving. You have a lot of API businesses which India is good at, and we want to hone on to that opportunities. Then comes the migration in terms of the same industry, movement from public sector to private sector. When we have already seen that happening. I mean, Air India getting sold is a prime example of that. And sooner or later, there will be an amalgamation between public and private sector as well. Then you talk about one migration into same business lines itself, from a voice oriented to a data, which has happened in telecom. Correct. So this value migration as a theme will work around each and every sector, but there might be into that also some of the sectors or some of the themes will work better than the others. And these are the themes which we will be capturing into this Golden Ticket Fund Series 2. So the expected beneficiaries of value migration first would be the financials part of the market. I'm sure you all agree but for any business to any country to grow as well, the financial aspect of this country has to be very sound. But into the financials, we're looking at movement happening from public sector banks to private sector banks. Okay, if you see on the left hand side graph on the top, you look at where private sector banks was when it came to the credit offtake part of the market, which means sorry, from 100 rupees loan given, 78% was at then in 2005 to 10 kind of a financial year funded by a public sector bank. But now that has actually got reversed. You look at 15 to 20 kind of a period, close to about 60% of is now funded by private sector banks. Same is the case with deposits as well. I'm sure you individually would always been liking to work with more private sector banks because of the ease, because of the convenience of doing things, and that is reflecting in deposits as well. We are currently at 50% when it comes to the deposit strengths, and that's why someone like ICICI Bank, someone like HDFC Bank, which are professionally run, someone like Bajaj Finance for that matter, which is one of the best played NBFCs that we have in India, they will be able to capture this market in a much better trend. The reason we are also looking at NBFCs, which is well managed NBFCs, is because NBFCs would have the last mile connectivity. Banks will probably not have a last mile connectivity, but the NBFCs will definitely have that kind of a connectivity. Second is the consumer durables and the discretionary part of the market. So, which is where I think it is very clearly evident. You look at the white goods penetration that is happening in India. Okay? Something like washing machine, refrigerator also is not penetrated more than 20-25% or maybe 30% odd. In a country like India, with the way things are moving up over a period of time. Sorry, just a second. Yeah, over a period of time, as the household incomes also increase, your discretionary spending part will also start increasing. As estimated till by 2030, where your essentials part will actually get stabilized to a larger way, but your discretionary spending part increases, because today, let's say a person has a bike, you would want to have a car tomorrow. Someone has one house, you would want to buy a second house tomorrow. So all this part comes under discretionary spending part, and even these white goods is a big part of the discretionary spending part. We are guessing probably 15% as a CAGR growth for this kind of a spend will be possible in the next 5 to 7 years kind of a time frame. Then comes the unorganized to organized piece of the market. We have unorganized space in a lot more industries that we can foresee. You look at something like jewelries, there is a 70 to 75% of the space which is unorganized in matter, and that's why someone like Titan has been able to have more and more market share, because specifically after GST coming through, it has been able to aid this movement from unorganized to organized pair of the market. Even for apparels for that matter, you look at something like paint industry has been able to do well over a period of time. And I think it is supposed to happen even in the footwear industry. I'm sure Relaxo, people who have tracked would have been able to see that kind of a growth happening in Relaxo in the last 5 to 7 years kind of a time frame. So over a period of time, formalization is going to happen slowly but gradually. People who are already into organized space will be able to garner more and more market share. Then comes the specialty chemicals part. Now, if I was talking to you prior to pandemic, possibility was that we would have stick to these 2-3 ideas itself and probably formed a portfolio. But post-pandemic, things have changed, and things have changed for good in terms of for India. Specialty chemicals is one segment that we are completely bullish upon, and the reason is very clear and evident. If you look at this data shown, we are just only 4% of the overall global market share when it comes to the manufacturing of the specialty chemicals. Whereas someone like China is about 26%, and some of the other countries are more than about 10 to 12% odd. Over a period of time, this will also happen there, wherein we will be able to garner our more market share, because post-pandemic, people have realized that we should not be dependent on one country for their manufacturing capabilities. There should be a certain backup plan, and India lies very strongly when it comes to our chemistry understanding, our way of doing businesses, and there is a government support as well, which I'll come to later on as well. But China Plus One as a strategy is certainly here to stay, and one particular sector which we are bullish upon is the chemical sector of it. And we are not saying that China will cut down completely from 26% holding to maybe 10%. What we are saying that our experience of share will move from 4% to 8%. Percentage number looks much lesser, but we are talking about in the actual terms, you're looking at 100% growth in the next 5 to 7 years kind of a time frame. That's why we are more bullish on this particular sector. Then comes production linked incentives. Now, it's a very, very important aspect from government side. If you look at production linked incentives, earlier governments used to have lot many focus on tax holidays. If, for example, if you're investing so much into a business line, there will be a certain tax holiday for 3 years, certain tax holiday for 5 years. But post, there was no other supportive system for starting newer and newer businesses or newer manufacturing tools. But now with the PLI, as it mentions, production linked incentive, it basically means that how much you produce and larger you produce, the good quality you produce, and the more you export, the better your chances of getting more and more incentivization. So it is on better incentivization on the more quantity and quality that you produce. So this is different than your normal tax holidays that the initial governments were trying to do. Secondly, also there is a big support from government end. So for example, if someone has backed up contract under PLI, there are government norms which allows them to have the funding come through banks. So there is a support system on the financial part as well that this government is trying to cater to. Initially, in fact, PLIs were only launched in electronics and automobiles, but the kind of response that it got from domestic market, it was humongous, and that's why another 10 to 12 different sectors have got added into. You look at something like semiconductors, textile products, IT hardware, not many solar products as well. So a lot of things have changed when it comes to the PLI part of it. In fact, one of the businesses also that can be beneficiary is something like solar industries. I mean, solar industries is into explosives making. Initially only utilized into coal mining stuff, but with the kind of push that the government has had onto this, they have been able to bag more government contracts on the military front, and also they've been allowed to export to neighboring countries their explosives. So this has not happened previously. This is the change that we have seen after PLI being launched, and that's what makes us believe that PLI is going to help us have more and more manufacturing units allotted in India, and we can get that market share that India deserves abroad. That brings me to Golden Decade Fund filtration process. Just because there are these 4 or 5 sectors which are we are concentrating on, doesn't mean we will go haywire and try and pick up any of the stocks. There is still going to be a filtration process. We are still going to look at the top 500 businesses according to the market cap. The first filter that we apply is about the management quality, what is their track record, so on and so forth. Then we come on to which are the sectors which will benefiting more in terms of as I told you, from public to private. Then maybe private banks would be a better fit when it comes to the value migration theme. Okay, we come down to around 270 odd stocks after that. Then we apply filters of ROC of 25% into this and earnings of 20% plus. As I told you friends earlier, bare minimum we look at 15% of ROC and 15% of earnings growth. Into this portfolio, we're looking at 25% of an ROC, so very good quality businesses, and earnings of 20% plus. We're looking at expected profits to be at least 20% plus when we select the stocks in the portfolio. So in that space, I would say, the portfolio will form with around 20 to 25 odd stocks, more or less an equated portfolio. None of the stocks will have a higher weightage than others. Averagely 4 to 5% of a weightage is given to each and every stocks. And when one of the stocks, let's say, reaches 7.5%, 8% of the overall portfolio, we kind of cut down the profits from there, bring it back to maybe 6% odd, because we don't want to be overboard one or two stocks in the portfolio. That increases the risk of the portfolio. At ASK, we are aware that his clients' hard-earned money need to be invested into equity, but at a certain level of risk, and that's why this is one of the risk mitigation measures that we diligently follow into the portfolio. Some of the key terms, of course, being an AIF, this is going to be a minimum commitment amount of 1 crore. We are currently calling in 30% of the commitment amount. So if the amount is 1 crore, then the 30% comes to 30 lakhs. So we will call in 30%, 30 lakhs right now. As a RM, you will get the credit for the whole 1 crore for sure. There is no lock-in into this product, but there is an exit load applicable for the first 4 years. The product is of 4.5 years. So last 6 months, the product is exit load free, but the exit loads are applicable of 5% for first year, 4% for second year, 3% for third year, and 4% for fourth year. For the fourth year, post fourth year, there is a 6 months window where the product will be exit load free. Client can redeem any point in time for sure. There is no lock-in into this product. In terms of the share classes, so there is A1 basically means that it is for resident individuals. B1 means as a share class it is for NRI clients. Okay. And based on the commitment amount, the management fees changes. So if the commitment amount is 1 crore to 5 crore, the management fees is at 2.5%. When the amount goes above 5 crores to 10 crores, the management fees comes down from 2.5 to 1.75, and so on and so forth. I think I would like to stop here and take more questions, because that would indulge a lot more of the crowd to get more questions on.
Thank you, Rahul, for that wonderful presentation. I request our RMs to please put up your doubts on the screen. People, let us not forget that the philosophy, the pedagogy of this fund comes in from IEP, the Indian Entrepreneur Portfolio, been run by ASK right since 2011. Just to add to the knowledge, 100 rupee invested in 2011 into IEP has grown to 800 rupee today, implying a compounded annual growth rate of more than 16.5%. Since the fund has underperformed over the past couple of quarters, 3 quarters, at the peak, the fund had returned a compounded return of 20% plus. Now, since the methodology of picking up the stocks, the 15%, 20% ROC filtration, the entire process, the team remains the same. We are confident of having base minimum 15-16% compounded returns coming out of this product. High conviction idea from HDFC recommended by us. I request the team to please come out with their questions so that we can Rahul can address the same.
Yeah, if you want, Amit, thoda IEP ka, if you want to address underperformance, I can address that if that is okay.
Yes, definitely, Rahul. I'll appreciate that. Please go ahead.
Done. So I'll take not more than 5 minutes to address this part. So what has happened in IEP? See, IEP is always going to be, or rather ASK is always going to be into high growth, high quality businesses. Okay. And if you see in the last year, specifically 2022, okay, the part of the market which did well, you had, in March, the war situation creeping up. So you had the commodities part of the market doing very well. And commodities as a segment is a very, very volatile segment. One cannot really predict how the commodity prices moves, how the commodity prices can come down sharply, and that we have seen already. Barring oil, most of the other commodities, if you see, went up in a quarter. In the next couple of quarters, it went out again, drastically crashing down. So, as a house, we are away from such segments of the market where there is going to be higher volatility. So maybe on a shorter period of time, we missed out some positioning on the returns on that part, but it is understanding the fact that this is going to be a very volatile segment, and we are away from that segment of the market. Second part, if you see in the last maybe 3 to 4 months, you have the most beaten down part of the market, which is the PSU segment of the market, doing well. PSU banks per se doing even fantastically well in a short period of time. But has there any structural change that has happened over a period of time in this PSU segment? We don't really see so. Maybe the books are cleaner at this point of time, but only time will tell, because these are government-oriented businesses. Tomorrow, the government can still ask them to, or rather force them to, invest into some stressed assets. And if the stressed assets don't perform, the NPA cycle will again start to increase, which has been the case with PSU. So we are categorically being away from this segment of the market, which has actually delivered some percentage returns into the index. And then came up the couple of stocks in the portfolio itself, which have underperformed a bit. You have someone like Davis Laboratories underperforming. We have someone like Sona BLW underperforming in the benchmark, into the portfolio. But there is nothing wrong with the businesses. It is just that Davis had been doing exceedingly well prior to that in the last 3 to 4 years. Last year, the margin was shrink because they used to make a drug which was utilized under COVID called molnupiravir, and the margins for that got shrunk. Okay, but if you see their custom synthesis business, that has actually gained a lot of traction. They invest about, they have about AIF'S with a lot of European businesses, wherein there are those higher businesses or global innovators, as they call them, invest 2,500 odd crores into investing into one particular molecule. And that molecule comes to someone like Davis, which is very, very high trustworthy factor business, because the molecule ka end process jo hai, that happens to making into a drug. So that particular trust factor is very high, and Davis has been able to maintain that trust factor on a long length of time because of some raw material increase price as well in the last year because of supply chain disruption. Their margins got shrunk a bit, but we don't see any structural business issue that has happened with Davis. They will be obviously able to come back much stronger, maybe in the couple of years time frame. Even for Sona BLW, their 40% businesses comes from North America, about 25% comes from Europe and China. With the global issues that are going on, there was a certain consensus in the market that possibilities that they will not be able to reach their numbers this year, which although their earnings were pretty fine, but again, the margins got shrink. The order books were still there for next 7 to 8 years kind of a time frame, but the end process of margins got shrunk over a period of time in the last 6 to 8 months kind of time frame. But again, it is one of the best businesses when it comes to the EV segment of the market. They have invested in their capex already. Now the competition is investing now in their capex, whereas these guys are already ready with their capex and newer designs when it comes to the EV segment of the market. So we are fairly confident that even someone like Sona will be able to come back. And there are 2-3 different names, but the idea is that the portfolio quality is pretty high. There have been business names which have delivered earnings. So if you look at the overall portfolio earnings, it is still in the excess of 22% odd, but the price movement has not happened. Today or tomorrow, prices will follow the earnings, and that is, prices are slave to the earnings. Possibilities that we might have a certain pain for maybe 3 months or 4 months or maybe 6 months, but post that we should be able to have the same kind of bounce back that we have seen always into this portfolio. It is just that ये साल थोड़ा ज़्यादा ड्राई हुआ है. You have already had the patient to be in for it for a year, maybe another 3 to 6 months, and you start looking at the turnaround part of it.
Fantastic, Rahul. Thank you so much for giving us that clarity. A lot of our clients are invested into IEP as a stream, and we are looking forward to Golden Ticket to have incremental investments from our client side. Friends, let us not forget that this contest is on until 30th of June. ASK Golden Ticket Fund is one of the focus products into it, a conviction idea. Watch out this space. We'll be having another call on the entire product deck on Saturday, 12 o'clock. This session will be taken by Mr. Pranab Unial and Devesh Mehta, both from the product and the investment teams. Also, I would like to state we have taken Finalica. Every RM, every BM, every one of us have been provided the login ID and the passwords. There were a couple of trainings which I've had in the past. I request everybody to please log on to this particular terminal of Finalica. A lot of analytics, lot of comparisons. You can upload the clients' portfolio, the gas reports, take the analysis to the client, make it a use case to showcase the client the opportunity cost he is having into the portfolio of not investing his funds into a managed fund like ASK or an ICICI. Thank you so much, guys. Any questions? Yet far, I do not see any. Okay, guys, thank you so much. Thank you so much. Thank you, Rahul. Thank you, friends. See you again on Saturday, 12 o'clock with the product deck.
Perfect. Thanks, Amit. Thanks all for your time. Take care.
Thank you, Amit. Thank you, Rahul, for joining us. Thank you to the customers for joining us.
Bye.